Good afternoon, everybody. This is Dr. Dino Patijalal from Foreign Policy Community of Indonesia, and welcome to our virtual public forum, where today we will discuss the impact of the COVID-19 on the Indonesian and world economy. This event is also being organized by the Indonesia Diaspora Network Global, and the president of that organization will also have a few words later on. So let's go straight to the topic. We have three speakers. We have former Finance Minister Khatib Basri, Dr. Khatib Basri, who I think is one of the smartest people I know. And then we have Enrico Tanuwijaya from UOB Indonesia. And then we have Dr. Abdul Abiad from ASEAN Development Bank. And we also have Mr. Said Zaidan Shah, who is the Deputy Director of Asian Development Bank in Jakarta. So, gentlemen, and first I have to apologize for not being gender balanced, so I will do better next time, right? But we are feeling the crunch of the COVID-19, and it's so fast. Started in early January, and now we're in April, and it seems that we are seeing not even the worst of it. This global pandemic is paralyzing societies, impacting everyone, and I think we are worried about whether or not this will lead to a crisis, and what kind of crisis, and for how long. I think last year people talked about uncertainties. Everybody talked about uncertainties, but I think this year, if there is anything certain, it is the fact that global growth is going to be down, and there's going to be economic crisis, and possibly even social and political crisis in some countries. So my question to you is, how bad will it be? Can we still avert a crisis? I start with Dr. Khatib Basri.
Thank you very much, Dr. Dino Jalal. Perhaps allow me to use my PowerPoint. I would like to highlight three issues about the mechanism, how the Indonesian economy will be impacted by this COVID-19. The second one is how deep it could be. You mentioned about the possibility of the recession, etc. And on the third part, I try to lay out some of the government policy responses. So let me try to do the screen share here. Here we go. Okay. Minutes, right? So 408. Okay. Now, let me start with the. Hopefully, you can see my slide here.
Yes, you can see.
Unlike the 2008, unlike the 2008 global financial crisis, you and I were in the government at that time.
Yes.
The current COVID situation, I would say that it's very different, because in the 2008, the global financial crisis was triggered by the subprime mortgage in the US. And it hit the Indonesian economy only through the demand side, because the global trade collapsed at that time. So the response, I was in at the MOF at that time. The response at that time was relatively easy. If the external factor, become a problem, then we just focus on domestic economy. Yeah. So what we did at that time, if you recall, Dr. Jalal, we introduced the so-called the keep buying strategy, induced the purchasing power, basically to focus on the domestic demand. And that's the reason why Indonesia could maintain growth about 4.6. But unfortunately, with this COVID, this is a combination of the both demand and supply shock. Yeah, on the demand side, because the China is accounted for about 20% of the global supply chain. So when China slowed down affected by this COVID, there will be a sort of like less demand from China. It's gonna hit country like Indonesia through the export investment, And because the export sector, affected, then some people in outside Java, especially in Sumatra and Kalimantan, get affected. So their purchasing power also affected. But in addition to that, there is also a supply shock because China also export components for many countries. So if China fail to produce, some of the components, it's gonna hit the global supply chain. The global production will decline. So if we respond to the situation using the old traditional policy like what we did in 2008 by boosting demand, when the production is slowing down, it will end up with a higher inflation. So the approach should be very different. In addition to that, and this is a very basic and very principle of the of the market. Market means uh, interaction between demand and supply, a meeting people. But one thing that related to the COVID issue is social distancing, lockdown. You are not allowed to have a physical presence. So it means that both buyer and supplier cannot meet. So it means that the market will not exist unless you can substitute by the online. Yeah, if this market will require a physical presence, the market will not exist because the social distancing, because the lockdown. So you can imagine the impact may come from the demand because people cannot come to the market, or also the supply because people cannot go to the factory. Yeah, so the impact will come from the both demand and supply. And then because of this situation, I recall on the last January, I was in Davos at the time at the World Economic Forum. It was quite funny because at that time we were still talking about how good the global economy into 2020. The possibility of the US raising the interest rate because US was in the good shape. But all of a sudden, end of January, we were sort of shocked by the news about the COVID from Wuhan, and after that, the financial market collapsed because it's flight to quality to the US T-bills. Some investor in Indonesia, 40% of our government bonds is held by the foreigners. They dump their bonds, they converted the rupiah into US dollar, and that's explained why the rupiah depreciated almost 20% in the last 1 month. So capital outflow from the emerging market. So the question is how deep the impact to the economy. The Indonesian MOF came up with a scenario that the GDP growth probably will be between minus 0.4% to 2.3%. So I put it just zero, between 0 to 2.5. And there is an interesting study done by my colleague at the Australian National University, Warwick McKibben and Fernando they look at they are doing the simulation, not only look at the China, because most of the study before just referring about the impact to the global growth, to the country's growth based on the case of SARS in 2003. So they are using the scenario, look at the scenario 4 to 7, where this include global. So I think the scenario 4, for example, the severity is relatively low, is unlikely. So the possibility is will be middle and high. Yeah, medium and high. So it means we focus on the scenario 5 and 6. And this is the number. Look at Indonesia, the last two from the bottom. Under the scenario 5, the Indonesian economy will get hit by minus 2.8% from the baseline. So it means that if Indonesian economy 2019 grew by about 5, we could only grow by about 2.3% under the medium scenario. But under the high severity, high impact, Indonesian economy will decline by 4.7%. So from 5 to become only 0.3. So the situation is quite, is very significant. Why is that? Look at this. This is the interconnected hubs, as I said, because China is the center of the production network, global production network. And if you look at the computer, electronic, and optical products, 30% of Chinese, share of the global export come from China. Intermediate good export, 28%. I don't want to go into detail, but my point is China is one of the most important supply chains supplier to the global economy. So when China get affected, the global supply chains also get disrupted, and that's the reason why the global production will decline. Now let me focus on the banking and the market risk, because the way that the banking sector will respond, they see the possibility maybe within 3 to 6 months, some of the companies will not able to pay their debt. So as a result, there is a risk of default here. Yeah. So the non-performing loan will increase. Liquidity, especially dollar liquidity, will be very tight. The question is, if we don't support the companies, especially the small, medium enterprise, they will collapse and there will be a massive unemployment. Yeah, so it is important for banking sector to continue to provide the credit line. The problem is, if we provide a credit line, then we'll end up with the high non-performing loan. So the government should step in. It reminds me with the situation 2008, during the global financial crisis, no one would like to export at the time, if you recall, Dr. Jalal. So what we did at that time, the member of the G20, the government guaranteed the export credit by trade financing. So the government should do the same. They should provide a guarantee that you should continue to lend the companies, and the government will give a guarantee. And that's the reason, one of the reasons why the government introduced the PERPU, the emergency state law, which is announced about a week ago. I'll explain to you later on. Yeah. Otherwise, there will be a problem of the non-performing loan. It's gonna hit, especially the small bank. It will have an impact on the financial stability. I'll explain about the crowding out effect later on. I don't want to go into detail. This is the stimulus package prepared by the government previously. But I would say that the first two stimulus packages were no longer relevant, because at that time, the government assumed that there is no social distancing. There is no lockdown. So, for example, they provide the discount for airfare and hotel about 10.3 trillion. But nowadays, of course, no one will stay at a hotel or go for tourism. Yeah, so this kind of model is not relevant. So the most relevant policy response will be under the social distancing. Before I go there, I just give it sort of like some leading indicators. This is based on data from the leading indicators that economic activities which require physical presence decline. EDC, based on the merchant data, dropped by 30 to 50% during the March last month. But interestingly, groceries and supermarket increased by 47%. The telco company relatively okay, because most of the activities shift into the online system. So some companies relatively okay. Yeah, but most of the companies which require a physical presence will be in trouble. So there is a risk of the massive unemployment. And as I said, not all economic activities can be conducted. Negative impact on the production and consumption. So the way I look at this, the government, I think if the government would like to come up with this policy response, they need to look at this policy response in sequence, because the traditional pump priming aggregate demand to boost purchasing power, to boost demand, monetary policy will not work. So there is no point for you to cut the interest rate if the needs for the people is a component. If the need for people is focusing on COVID. Yeah, so stimulus package should consider sequencing of, the first one is you just need to focus on the health sector, because getting the outbreak under control should be the top priority. Forget about anything else. Yeah, health sector, it means that you provide rapid test kits, ventilators, paramedic, hospital, etc. Focus on that one to contain the outbreak. That will be the first priority. Because if people get sick and they cannot work, the economy will get hit anyway. But there is a consequences if you focus on the health sector, because maybe you require people to stay at home, like work from home. So the government need to provide the social protection. You are being paid to stay at home. That is why the BLT, we call it the BLT, the bantuan langsung tunai or the cash transfer, is very important, because we need to compensate people to stay at home. Otherwise, they will go out, because some of the worker probably they need to go to for like ojek driver, etc. They need to work, so there is a need of compensation. So the second focus should be on the social protection. The third one is, as I said, 3 to 6 months, many companies are under financial pressure. They cannot pay their debt. If the banking sector stop the credit line, they will stop working, massive unemployment. So the government should step in to provide the credit line. Yeah, we can discuss later on. Number 4, seems to me that the government should focus on urban. Why is that? Because the density of the population is very high. 55% of the population live in urban. You cannot cover everyone. And this is very dangerous. If there is not enough stimulus on the urban, people will go to the rural area. Health facility in the rural area is very poor. Yeah, once it's spread out, you cannot control it anymore. So focusing on the urban is a very important. And after the pandemic can be overcome, I don't know, after 1 year, 1.5 years, I don't know, then we can talk about the traditional pump priming counter-cyclical policy to boost purchasing power, to provide the relaxation. Tax relaxation will not work because company will be in loss anyway. If you are lost, you don't need to pay tax, right? So if you give a tax relaxation, will not help. You just need to focus on the 3 things: health sector, social protection, and to support the companies. That's it. And the long term, what I believe is there will be a different global supply chain. Why is that? Because people learn you cannot put all your eggs in one basket. So you cannot allow China to become the largest global production center of the global production network. Everyone will start to diversify their production base. And Indonesia could take this opportunity on this. I remember when I was a chairman of the investment board, there was a flood in Thailand. Yeah. And then Toyota in Southeast Asia, they cannot produce, they cannot continue their production because they get hit by the flood. And we went to Japan to persuade Japan to put Indonesia as a production base. And Toyota decided to do it, 3.7 billion US dollar, not because we are doing that, but simply they need to diversify the risk at that time. So I could see maybe, after this pandemic could be overcome, there is an opportunities for us. Last but not least, people will preserve cash, because 2 years from now, maybe there will be some companies, good companies available in the market because they are under the financial distress. Yeah. So if you preserve cash, then there will be a business opportunity. Dr. Dino Jala, I think I stop it here, and then I'll be happy to have a discussion later on.
Okay. Before I go to Enrico, let me just ask a short follow-up question, Dr. Patrick Basri. You were involved a lot in G20 when you were finance minister. And as you know, the G20 has come together and they are trying to mobilize $4 trillion stimulus and so on and so on. From your viewpoint, is G20 providing a credible platform to get the world out of this potential crisis?
Yes and no, because the situation is quite different. G20, if you recall, in 2008, before President Trump became a president, G20 got a full support from the US. But now situation is very different because US does not entirely support the multilateral, for the multilateral approach. They don't put them, resources on the World Bank, on the IMF, also G20. So even though there is a sort of like, agreement between the leaders in the G20, I'm not really sure about the implementation. The situation was very different compared to 2008 because the big countries are committed at a time. That's the first one. The second one, this will require huge resources. Let's say Indonesian government, for example, we run a budget deficit perhaps 5%. Yeah. The question is, how do we finance this? Because if we focus on the local, there will be a crowding out. But if we go to the global market, the yield will be very expensive. So it is very important for Indonesia to get the international support from the World Bank, the Asian Development Bank. I recall during my time, we do have the scheme, the so-called the deferred drawdown option. Colleague from the ADB could talk about it. The deferred drawdown option is if we don't have an access to the market, to the global market, because the bond yield, the yield is too expensive, yeah, we are allowed to borrow money from Asian Development Bank, from World Bank, Japan, and Australia at the rate 100 or 200 basis points above LIBOR. So it's sort of like a concession loan. But unfortunately, this kind of scheme is no longer available. So it seems to me that finance minister, central bankers should call a sort of like, international support in order to addressing this issue.
Thank you. Now I turn the table to Pak Enrico Tanuwijaya of UOB Indonesia. Pak Enrico, please give us your take on the impact of COVID-19 on the Indonesian economy and world economy.
Okay. Yeah, thank you, Pak Dino, and hi to Pak Khatib, Pak Abdul, and everyone. Let me just quickly share my screen. Basically, what I'm trying to get down is basically to complement what Pak Khatib has presented. So I think it boils down to two major issues. Yeah. Firstly, we are here for the long run, which means the recovery, if anything, will be a protracted one. And the fear of a second or third wave back boils down to two major issues. The first one is the public health response, nothing that the financial policymakers can do. That's on your left side chart. And then the knock-on effects and the right, or rather the appropriate policy response can be best presented in this slide. Of course, I'm not seeing that the effective control is rapid and effective as of now, whereas for intervention for economic policy response, I would say is partially effective because the monetary policy has been ultra loose. It's only useful when the recovery sets in. But what I want to highlight is basically we are in an uncharted water, not even comparing to 1929, added by the Spanish 1920, the Spanish flu, plus the extent of 2008. So it's a combo of three different shocks altogether hitting the demand and supply. My best bet is if we can get into A1, where there is effective response, but there is a fear of virus resurgence, but the public health response continue to be built up, coupled with the partially effective interventions from the economic policymakers, we are in it to have at least a slower long-term growth, a muted world recovery. So it's a kind of semi-U shape, not really a V shape like an A4 scenario. And I better not hope it's not going to be B3, yeah, because it's pretty much a doom and gloom. So the 7 pain points that will disrupt Indonesian economy is best depicted here, which means that Pak Khatib also mentioned about the financial distress that will cause the delayed spending, closures, reduced hours, layoff, postpone investment. But to me, what's more important is the C component, because in Indonesia, it accounted for 54% of the GDP. This is the one that needs to be targeted. And Pak Khatib is duly right. The BLTO direct cash transfer will basically answer the job. But the question that I beg is for how long and whether what the government has done is enough, what should they been doing, and how the banking sector could actually play a cooperative role. Yeah, so basically the 7 pain points come into, the lower taxes means your government spending will have very limited firepower unless you have a lot of loans or even swap lines from the Fed and everyone else. And then the international demand shock will actually hit us, but not so great as compared to the domestic supply chain shock. but businesses is the one that I fear the most. Should we actually salvage the key industries that will probably be hit? So in that account, I'll come back to my growth estimate, but we come up with at least a broader analysis on what are the less impacted sectors and more severely impacted sectors. Unfortunately, those that command the largest share of the economy, like mining, manufacturing, construction, and wholesale retail trade, are basically the one that we believe are more severely impacted compared to agriculture, infocom, and human health. So basically, the government needs to kind of make sure that the stimulus, which at this moment I believe there should be room for more, should be targeted directly into those sectors without firstly crowding out the private and banking sector, but to look at avenues and basically what kind of best mechanism they can do, because what we are in it is for a longer and more protected recovery. On that note, I think our in-house model kind of predicted that GDP will conservatively be at about 2.5% because the domestic demand will be hit the most, whereas our export and imports were pretty much muted, but we are focusing more on the role of to revive or at least maintain the private consumption, as well as how do we deal with the delayed investment expenditure. Yeah. So these are the government estimates, which I think Pak Khatib also mentioned earlier, from the adverse to severe scenario. But I think if the policy response are done quick enough, assuming that we are in it for a more protected recovery, and assuming the government are ready to do more, I think we can even avoid the adverse scenario. So like what mentioned earlier, the first two rounds are irrelevant, but what I want to focus is on the third round of stimulus, and at the end of the day is number 4. That's very important, which is the financing to support the recovery. Because the first 3 are straightforward. You're spending 75 trillion to health and then social safety net, industrial support. But what I'm inclined to discuss more is how are we going to finance using this 150 trillion that are pretty much not set out in details yet. Yeah. So basically, if you look at the key sectors that could be affected, sorry, I'll jump a few slides earlier just to give you the context. These are pretty much the loans setting in the Indonesian economy. There are about 5,600 trillion of outstanding. And at the moment, the data is a bit lag. We are already having 142 NPL case. So assuming that, based on my earlier chart about the severely impacted sector account for a good minimal 50% of the economy, more provisions should be garnered towards this. Yeah, so basically, even those that absorb a lot of workers, the MSME, pretty much account for more than 1,000 trillion of the outstanding loan. So at least this is the base scenario, assuming everything will collapse. So it pretty much covers the entirety. Of course, I'm still running the simulation, but my back of the envelope calculation, we will share it to you once we manage to publish it. At least we need 4 to 5 times of that 150 trillion to be set aside for the recovery to make sure that we are not in it for a protracted slowdown. So in terms of the economy, let me just highlight again, because of the 7 pain points in the economy, I think the government needs to pretty much set their eyes on the biggest part of the economy, the consumption part, while allowing the delayed investment to resume over time. But along the way, we are also facing the financial market crisis, which is the dollar strength or vis-a-vis the IDR weakness. So on that account, I think what happened is basically, I will just quantify what Pak Khatib mentioned earlier about the outflow, but I want to emphasize that what happened at this moment is different from 2008, nor 1998 or 1929. The first one is there is a dislocation in dollar liquidity. The Fed has cut to the bottom, inject another 1, 2, or 3. They're going to be more trillions. But look at the difference between the 1-month LIBOR and the Fed funds rate. they are not converging, whereas in historical sense, they should be. The dislocation happened shortly in 2008, but then it corrected immediately once they can quantify the economic shocks. My second point, we have not been able to quantify the extent of the damage. That's why until it happens, the Fed is going to keep on pumping the liquidity. Even they're buying junk bonds for the sake of injecting liquidity, but the flight to safety to dollar assets will continue at least until there's a convergence between the 1 month LIBOR, the interbank, how the US economy is run, to the Fed funds rate. This is why I think the rupiah will keep on depreciating to that sense, coupled with the second point, whereby the capital outflows this year has been very high in terms of the bond market. I just updated this number as of last Thursday, before we went into long weekend. The number has increased to 8.8 billion. Don't be deceived by, there will be an additional at least 4 billion inflow in the next week or so, because we just managed to issue, up to 50-year bonds. So basically, the inflow will be a tad better, but then afterwards, there is a risk that if there is a resurgence or if there's any panic in the market, we may see a continued outflow. So that will give the second reason why the rupiah may still be under pressure. The third one, of course, is seasonal. In Q2, we have to pay dividend externally, and the external debt payment will mean that people are front-loading much of the dollar payment. Yeah, but what happened is that I think it's pretty much safe to say that what we've seen here is pretty much different from the 98 in a sense that it took only a few weeks to depreciate 700% in the IDR, whereas it takes a good 8 to 9 years to depreciate about 50% for the rupiah. That is equivalent to about 5 to 6% depreciation, except that this time, when we depreciate double digit close to 16%, this is an overshooting. And so be it that basically when the market settles down, I think Indonesian rupiah will gain its strength in a pretty relatively quick time. So what happens here is basically only on the portfolio. We need not to be overly worried. This is an adjustment which I think allowing the flexible exchange rate to absorb the shocks, and also looking at the difference of the yield spread. The dollar bonds for Indonesian governments are still very attractive, meaning that people are still buying into ROI dollar bond, but the correction are big in the IDR government bonds, and BI did exactly the response to maintain that the yield remain relatively stable. When the foreigners sell off, they are the one buying. So these tables are not updated, but you can just imagine the foreign will get more minus, Bank Indonesia will get more plus. So I want to assess the point that basically there are two things that I want to highlight in terms of the risk going forward. The real economy, we are going to be here pretty much for a more protected recovery. Yeah. So the government needs to rely almost entirely on the fiscal stimulus, but I think the monetary policy has pretty much done the setting so that when the recovery rebound and took place here, it'll be very quick. So I think it's like providing the necessary environment. So left and right. But I think the government needs to do more, especially allowing only 150 trillion to kind of quote bail out the sectors that will be hit the most. I think they should be ready to do more. And basically, I've outlined the sectors which I think needs to be focused more. We can discuss it during the Q&A, which one that actually absorb more so-called workers. And I want to close off by saying that in terms of fiscal, I know it's under pressure, but we should use this opportunity to bring the 55% informal sector of the economy. If they want to get this aid or loan, you should formalize them, because this will be beneficial in the long term to increase the tax base. And at the end of the day, your fiscal base, the multiplier, as well as the kickback later on will be much faster and more sustainable, and actually ensuring that when we return to a fiscal discipline of 3% or lower, we will have a sustainable growth. Okay, I will stop here and give it back to you. Thank you.
Thank you very much. Before I proceed with Dr. Abdul, I want to tell our viewers that if you want to ask questions, you can ask questions after You can post your questions now by posting your question on the comment column in the YouTube or the live chat in YouTube, and you can write your questions, and then we will look at your questions after the last speakers has spoken. So now I'll move to Dr. Abdul, who is in Manila. He's under lockdown. He is at home. And we are grateful that he is able to join us today. Dr. Abdul from Asia Development Bank, Manila.
Thank you very
Please.
much. It's a pleasure to join you guys. So again, this is an extremely difficult period to be trying to think about the outlook for the regional and global economy, and that's what I'm going to focus more on, given that our previous two speakers, Pak Katib and Pak Enrico,
I think the signal dari Pak.
And yeah, I mean, so let me begin by summarizing. Sorry, let me see if I can get smooth there. Let me begin by summarizing the key messages of our Asian Development Outlook report, which we released 10 days ago on April 3. It's available for free on the ADB website. One of the challenges, I think there are two big challenges doing forecasts now.
Dr. Abdul, we haven't seen your slides. Can you make sure that your slides are posted? Yeah.
Okay. It does say it's sharing already. Well, sharing is paused. Let me see. Resume share. Okay. Let me see. Okay, let me stop sharing for the moment and share it again. Give me 1 second.
Okay,
You can see
you're good. Yes, good.
All right. Yeah. So let me summarize first the key messages. Keeping in mind that these forecasts came out 10 days ago, April 3, and 10 days in this current environment is an eternity. And not only that, April 3 was when we launched, but basically the information so the forecasts were finalized, and they took into account information up to March 20, and that is like a really long time ago. So I'll talk about that and how that has shaped the forecast. But basically, the first key message is that we've downgraded our growth forecasts for the region, for developing Asia, to 2.2% this year, primarily because of the pandemic. We expect a rebound to 6.2% in 2021 on the assumption that economies are able to contain the outbreak and normalize economic activity within the year. Now, I'll talk in the risks about there's very much the possibility that that does not happen, that it's not a V-shaped recovery. Okay, second, the downturn will really touch all the economies in the region. I'll show that in one of our slides. The two largest economies, China and India, will both slow substantially this year, and pretty much across the board, all the economies in the region will also slow. Third, inflation in our forecast is ticking up slightly to 3.2% this year. A lot of it is carryover. You have still high food prices in China because of African swine fever, but there are also many other forces at play now in inflation. There are potential supply disruptions, as Pak Katib mentioned. There's also, of course, weaker global demand and weaker domestic demand, and also lower commodity prices. So inflation, there's much more uncertainty about the inflation forecast now. Okay, and then when it comes to risks, basically risks around the current forecast are extremely large, primarily because of the very uncertain evolution and effects of the COVID-19 pandemic. So growth could be lower this year and the recovery slower than we were forecasting. And I'll talk about that when I get to our risk slide. And basically, because the environment is changing very rapidly, we will be updating our forecasts more frequently than we typically do. Usually we would issue an update in July, but we will likely issue an update as soon as we get Q1 numbers. So probably maybe around early to mid-June, we will issue revised forecasts. So let me quickly walk through those main points. So the left-hand side chart shows our growth forecasts. The red line is the forecast for developing Asia, and you see that it is growth this year will decline to 2.2%. That's about a 3.3 percentage point reduction from what we had forecast in September of last year. If you take out the newly industrialized economies, that would be the blue line, and basically you still see a very similar pattern, a drop to 2.4% compared to what the 6% we had been forecasting. And here you see the V-shaped recovery, and I'll talk again a bit about what that requires and what the risks are to achieving that. So one reason, obviously, that the region will be hit hard is that it's really now a global pandemic, and it's hitting the major economies, including the G3. So the chart on the right basically shows our forecasts for the US, Euro area, and Japan. Basically, contraction so we've revised our G3 forecasts down by about 2 percentage points, and these are actually already outdated. So as I mentioned, these were based on data up to March 20, and basically in the last 3 weeks, we have seen in the US in particular, 16 million new unemployment benefits claims, by far the largest in history. And if you look at consensus forecasts for the US now, they're basically in the range of a contraction for this year of about 3 to 6%. For the Euro area, you have similarly large numbers from consensus forecasts of, between, maybe 4 to 10%. The ranges are pretty large. For oil, we're forecasting an average of $35 for Brent oil this year. That would mean that from now until the end of the year, it would average about $30 per barrel, because in the first part, since up to this point, it's averaged about $50 per barrel. So here's the chart on the left basically shows growth in the two largest economies in the region, China in red and India in blue. And basically they're both declined. They were both already slowing down last year for different reasons, and they will continue slowing this year. So in China, we already knew last year there were trade tensions and also weakening domestic demand. But now, obviously, we know the economy was hit really hard in Q1, and you see that in the top right chart. Basically, industrial production, for example, real industrial production declined by 13% year on year in January and February. Services production, they have a monthly series, and it contracted by about the same amount. And we know that in March, it hasn't recovered. So it hadn't recovered fully. So we know that in China in Q1, we will be seeing double-digit decline. On the demand side, also, you see retail sales declining by even more, by more than 20% year on year in the first 2 quarters. In India, the story has been quite different. It was a story about there's tightening financial conditions. They had a collapse of a non-bank financial institution there that has led to a tightening of credit, and that that slowed the economy already last year. And then obviously the global conditions will be weak now. So COVID, the outbreak in India is still relatively muted compared to other economies, although as we know, that situation can change. But basically weak global demand will drag it down, and plus the containment measures that are being implemented. And so we expect India to also slow this year. Here are our forecasts for many of the other economies in the region. And what you can see here is that for 2020, we revised our forecasts down for virtually all the economies. More open regions like East Asia and Southeast Asia have seen bigger revisions, and also economies that are more tourism dependent. So economies like Fiji or Thailand, for example, where Thailand, for example, where we're forecasting a 5% contraction this year. As I said, once our underlying assumption is that the outbreak will be contained this year, and you'll see a rebound in growth next year And it'll be, the reason you're seeing relatively high growth rates is a base effect. You're comparing to depressed output in 2020. When you get to 2022, growth will return to more normal levels. And so lastly, let me talk about the risks, because basically we are in a situation where point forecasts are even more, are even less likely to materialize than they are under normal situations. So I would say that the forecasts we have, that almost all the risks are on the downside. So this, the forecast first, as I said, assumes containment this year and a return to normal activity next year. But there are many caveats to this. The first is that the outbreak can and actually has already spread to more countries. The second is that it may take longer to contain. So our assumption is that each economy takes about 3 to 6 months, between 3 to 6 months to both contain the outbreak and to start to normalize economic activity. But it may not take that. It may not be that quick. You can have resurgence of cases. And then also economic effects may be larger than we're anticipating. I'll talk about that in a couple of slides. Pakatiba talk about both the speakers had talked about the potential for financial turmoil and crisis, and that's definitely possible. And I think both speakers had also mentioned about when we come out of this, the global economy and regional and global economy may look very different from where we were, how it was previously. In particular, again, sort of this. I think the globalization already took a hit from the trade conflict that we've had over the past 2 years, but this is an additional blow to globalization. They've already talked about the need for quick and decisive policy actions, focusing first on public health and on supporting social protection, supporting the most vulnerable, and corporations, ensuring adequate liquidity, especially for SMEs. And I already mentioned forecasts quickly become outdated. And so we will be updating our forecasts. So I want to spend my last 2 slides talking about the economic impact of the COVID outbreak. So that's implicit in the growth forecasts. But what we did was we did an analysis of how COVID would affect economies in developing Asia through various channels, through declining tourism demand, through trade and production linkages, and through declines in domestic demand, both domestic consumption and domestic investment, as a result of both the outbreak, so precautionary behavior, but also containment policies, which would require people to stay at home, and which would also take a hit on supply, as has been mentioned. So we first put out our assessment. The first assessment we put out was on March 6th. And since then, there have been 3 big changes that have taken place. The first, as you see on the left, is that when we did the March 6th assessment, the outbreak was still primarily concentrated in China. 93% of cases and 97% of fatalities at the time were in China. But as you can see, just over the last month and a half now, it's really become a global pandemic. And by now, only 5% of cases are in China, and for Europe accounts for about half of total, the US for about 1/3, and the rest of the world for about 20%. The second big change, which follows from the first, is that the use of containment policies, including community quarantines and travel bans, has really increased dramatically, especially from mid-March. And so travel bans, if you just thought about travel bans, we've calculated that they affect about 740 million international trips in a typical year. So that's about more than half of global total. And obviously, even without travel bans, people just don't want to travel. So you're really going to see a big hit on travel, on trade. And then the third new piece of information since our first assessment was the data that came out of the PRC that I showed you earlier, that big decline in on both the supply side and the demand side, which tells many countries, this is what you might expect as you go through the outbreak yourselves. And so we initially assumed smaller shocks to consumption and investment, and we've had to revise our assessments because of the numbers we've seen from China. And so our updated scenarios reflect this new reality, and as a result, the estimated economic impacts are substantially larger. So for the world as a whole, we estimate that the COVID-19 pandemic will result in a loss to global GDP of between 2.3% to 4.8%. And so if you think that, global growth last year was about 2.5%, 2.4%. So definitely a global recession is a definite possibility. Let me note here, this does not account for fiscal stimulus. And so for policies that will ameliorate these effects, and so that will help. But again, sort of, as Pakatib had already mentioned, those policies will, the effectiveness of those policies will be less if you haven't gotten those the outbreaks under control. PRC, we expect an impact of close to 5% of GDP. So as you saw, we've revised our forecast down for PRC close to 2%. For the rest of Asia, 1 to 2%, but this is only the global spillovers. If on the next slide, and we have this in the report and also in a more detailed spreadsheet, that 1 to 2% is just the average of the blue bars. The effects of the impact on developing member countries from the spillovers from the global pandemic. If your economy has a domestic outbreak or is undertaking containment policies, you would need to add those orange bars. And so, for example, for Indonesia, our estimated impact from the COVID-19 outbreak is anywhere between 2 to 5.4%. So again, it's a pretty large estimate because a lot depends on how things are implemented and how bad the outbreak is. So let me end there, and I'm happy to continue the discussion after that. Thank you.
Thank you, Dr. Abdul. I think before we go to take some questions, I want to invite Syed Zaidansyah, who is the Deputy Director of ADB Indonesia, to say, to just briefly explain what the ADB is doing to help the Indonesian government on the COVID issue.
Thank you so much, Dr. Jalal, for this. Yes, I suppose ADB as a regional development bank, we are here basically to try to assist our developing member countries and including Indonesia, facing the economic turmoil due to the COVID-19, due to the impact of COVID-19. Now, as I think Pak Khatib Basri has said earlier, one of the problem that Indonesia encountered because of the COVID-19 is that there's a huge budget deficit. As you know, we were looking. I mean, Indonesia under the state finance law is mandated to have 3%. Is allowed to have 3% fiscal deficit. However, under the Reset Perpu, that limit has been lifted. And because of the lack of revenue generated and the increase in expenditures, Indonesia is looking at having a fiscal deficit that goes beyond 3%. If you look at the projection of the central government revenue, in 2020, it's expected that using the exchange rate of 17,500 rupiah per US dollar is looking at basically having a decline of around 27 billion US dollar in terms of revenue, and looking at an increase, a substantial increase in terms of expenditures. And some of these expenditures are COVID-19 related expenditures, including the expenditures related to the stimulus package that the government, the 3 stimulus package that the government has introduced. Now, as you know, for example, even in the health sector, there's a requirement to have, under the law, to have 5% of the state budget allocated for the health sector. This year, we're looking at least 8.1% of the state budget allocated for this, and there are other, other fiscal stimulus that has created additional expenditures. So how is ADB supporting supporting Indonesia one of our most important member country. One of the ways that we're doing is we're providing, for example, a grant, in the amount of $3 million US. This is a quick relief grant in order to basically help the government meet some of its most urgent medical supplies, to be able to handle the COVID-19, the impact, the health impact of COVID-19. A budget support. The amount is still being discussed, and we're also mobilizing budget support from other donors as a total package to be provided to the government, and this will be a substantial amount that hopefully can plug some of the deficit, and this is on top of that. We also have basically what we call as contingent disaster financing facility. So this is not entirely similar to the deferred drawdown option that Pak Khatib Basri mentioned, but we do also have some form of a contingent disaster financing that we're looking to provide to the government. The initial support, we call it is counter-cyclical support facility, CSF. We're looking at having this basically ready for disbursement by the end of April. In terms of the contingent disaster support program, we're looking at basically providing this by the end of August. We're also looking at providing a project, an emergency assistance project that will be able to deliver the real goods and services to Ministry of Health or to other ministries that are basically looking to combat the health impact or the human side of the COVID-19. So we have grant and project that will be provided to the government for procurement of goods, services, and we have budgetary support. We're looking at 2 additional budgetary support for this. This is in addition to our ongoing loans or grants or financing to the government. So ADB is definitely trying to find ways how we can work together to support the government in this trying time through various policy arsenal or policy modalities, financing modalities that we have in our arsenal. So maybe I'll stop there and happy to elaborate further in the Q&A if necessary. Thank you.
Okay, good. Let me begin with 2 questions, one from me and one from the Jakarta Post. The question from me would be, look, in 1998, situation was so bad, the economy contracted by 13%, and we had political crisis on top of that, and so on and so on. And we ended up with riots on the street. 2008, alhamdulillah, it did not happen in Indonesia, but in some other countries, we did see the economic crisis leading to food riots, social crisis, and so on. Am I right in assuming that the economic challenges that we have now is such that the likelihood of us seeing a food riots and other kind of riots on the street is much less likely compared to 1998 or 2008 in some other countries? Am I correct in saying that for Indonesia? Pak Khatib Basri?
This is a very tough question, Pak Dino. I have to say it depends on whether the government will be able to provide enough social protection. And that's very important. Because if you ask people to stay at home, you need to compensate them. That's the first one. The second one is about the food supplies. Because if the food supplies is not available, or if there is a shortage of food, then there is a risk of the social unrest. So I think the government need to focus on those 2 issues. Social protection. If you require people to stay at home, you need to compensate them. You need to give them money. The second one, you have to ensure that there is enough food supplies. Otherwise, it will, may trigger the issue of the social unrest.
From Adrian, the Jakarta Post. Do you think the stimulus of 2.5% of GDP is enough to prevent economic meltdown? And do you share similar view that with Bank of Indonesia that rupiah could strengthen to 15,000 rupiah? Anyone want to answer that? From Adrian, the Jakarta Post.
I can give a view on the 15,000. As I've mentioned earlier, this is an overshooting of the exchange rate because, by right, looking at the current account deficit of roughly about 3%, give and take, and plus minus with some SDs, rupiah depreciated after the global commodity collapse in 2012 up till to date at an annual rate on average about 5 to 6, which is acceptable. So if they triple or even quadruple, it's called overshooting because of the three factors: the dollar dislocation, which means everybody is flocking into the dollar on scarcity basis. Number two, there's continued capital outflows because during uncertain times, they only buy dollars. And thirdly, there is a seasonality in dollar dividend payment. Once the factors are corrected, once the LIBOR approaches the Fed funds rate, dislocation disappear, we will see a massive strengthening of the IDR coming back to, depending on the peak. If the peak is 18,000, you may shoot back to 15.5, 16. If it's at a current level, probably it can go back to where it was before. But I think, the uncertainty remains, which means that because of those three pressures, it may continue to go up. But when it comes back, Indonesian yields are very attractive. Back in 2008, the yield-seeking behavior will snuck back into the mind of investors. It will come back very, very quickly. The levels I cannot give right now, but it will come back very fast. And that's why Bank Indonesia has to keep liquidity abundant, doing the support in terms of, the rates, although I agree with Pak Katip, because of we are over-reliant on the external financing, further cuts may not be necessary up to, the Fed stage. But yes, it will come back fast, but depending on how stretched it will go. My sense is based on the data, it's not the end yet. This could be a temporary relief, a relief rally, market is thin. So just be careful not to caught off guard, but also at the same time, not to be overly worried because this is an adjustment in the midst of dollar liquidity, dislocation, and seasonal factor, as well as the uncertainty is all reflected.
Okay, thank you. Hiskia from PricewaterhouseCoopers asks, which sectors do you think will recover the quickest and for the government to prioritize after this pandemic ends? Which sector will recover quickest? Anybody?
Maybe Enrico?
Enrico?
Okay, from the banking side, let me share again on the slide, yeah? Okay, I'm gonna share this slide and, the difference that I think, just to reverse back to a few questions earlier, this time the social media or the online support actually help a lot, in terms of food delivery, or, ordering the raw food, whatever it is, I think is pretty good. But on the downside, the social media will actually accentuate or make negative things bigger than what it looks like. So this is where the government needs to control. But other than that, if you look at the Infocom, we're still expecting them to conservatively grow at 10%. It could be more, but then the ramification is more on the sector that will be hit the most. If you look at the proportion of labor market that's absorbed the most, is actually in agriculture, forestry, and fishery. They account for about 23.7% of 180 million working people. Yeah, we haven't mentioned about the informal sector, which accounted for half, more than half, 55% of it. How is the government going to tackle that? Because you're not in a formal sector, but at the same time, when this thing all rebounded, I think those that have relatively strong cash flow, even in the manufacturing, even we are predicting, more severely impacted sector, but there are big corporations with healthy cash flow, which I think they can survive. But the government really has to do a means testing and know exactly. I've shown you the chart about the SMEs, right? I think if you look at the SMEs portion, which needs to be taken care of, is basically those accounting for about half the size that operates in wholesale and retail. This, I think, may bounce a bit lagged. So that means the government needs to be in support for a longer. So mining, I think, is very interesting because if China does recover very quickly, this will be very fast. Just to put things in perspective, in January, we are very optimistic on the 3 C's of Indonesian exports: the copper, the CPO, and the coal. Suddenly come January 25th, which happens to be my birthday, set aside, the whole thing breaks loose. And you know, if that comes back, I think these commodities will actually be very, very crucial, you know, because they absorb a lot of manpower. So I think those with a healthier cash flow will definitely be bounce faster, but the government within the space of the MSME needs to pay more attention. If you look at the amount, you know, judging from 405 trillion that they showed up earlier and 150 trillion, which I believe will be taken care of for a recovery measure, I think they need to focus first on a sector that absorb the most laborer, and secondly on the MSME that also absorb laborer, but the cash flow are very strained. So maybe I stop here. I hope that suffices.
Okay, the next question is a bit sensitive. I'll leave it to your economist if you want to answer this or not. Devin from PT Karisma. Should the government delay any game-changing regulations such as omnibus law to prevent another systemic shock this year? And I want to add a little addition. Should we even reconsider moving the capital to East Kalimantan as a result of this crisis? Yeah. Go ahead, anybody?
Well,
too sensitive.
Pak Dino,
Yeah.
seems to me that, you know, regardless, talking about omnibus law or this moving the capital city, I think the government just need to focus on 3 things at this moment. Yeah, we can discuss about other things later on. To control the pandemic, that would be the top priority. Yeah, because without that, as I said, you cannot, you cannot improve the economic situation. So to me, this is a very short term. We better focus on allocating funding for health, for social protection, and then to help some companies. And after that, we can talk about other things. Yeah, but don't derail our priorities from these 3 issues at this moment.
Thank you. Anyone else want to add? No? Okay. Wiki from, this is the only government official, I think, who's posting a question. He's from Directorate General Pajak. His question: Indonesia has issued a $4.3 billion global bond. On the other hand, we have the option to issue domestic bond. What do you think are the exact pros and cons to issue domestic bond? Katik, maybe?
Okay. Well, if you issue a domestic bond, there is a risk of the crowding out, because maybe people, because the bond yield, the return from the bond will be more attractive compared to deposit rate at this moment. So they will shift their funding from the third-party fund on the banking sector into government bonds. So there is a risk of a crowding out. But if you issue the global bond, I think we are lucky. We have the 0.9% for 10 years nowadays. But probably in the future, it's not going to be easy, because this could be very expensive when there is a shortage of the liquidity in the global economy. And that's the reason why I think it is important for us to sit together with other central bankers, other countries, to get the international support, to explore the possibility to work with the Asian Development Bank, the World Bank, currency bilateral swaps, to explore everything. Because I think the government, it is important for the government to open for every possible source of financing, both local, international, global bonds, and also the international.
Can I add a little bit, Pak Dino, if I may? I think it's somewhat a vote of confidence that they can issue 4.3 billion at this stage. What does that show? Is actually Indonesia is deemed as one of the more, or if not the most systemic part of the Southeast Asian. So I would reckon that the fact that BI said they stand ready to be the primary, they ready to be involved, I think it's a good thing to make sure that the yield are not excessive. But the fact of the matter is Indonesia could be a little bit pessimistic in trying to issue in the markets, because if you look at the surrounding of the neighboring countries, they really need Indonesia to get through this together. We're the largest market in ASEAN, and if we are not going well with this, where do you think the remainder of 300 million is going to be, impacted? So, I mean, one consideration is that you may consider to issue probably not in dollar per se, not in yen or euro, but the internationalized currency like Singapore dollar with the kind of liquidity that they have is probably an option without risking too much of a crowding out effect in the economy. But having said that, I would believe that the fiscal readiness to basically work together with the banking sector to understand which sectors that need to be taken care of, because we are in it not for the short haul, needs to be taken care of from the domestic side. But in terms of the financing, I think we need to take this opportune time, be very flexible, be very assertive to ensure that basically, yes, we are in this crisis together, but we need help together also to basically come out of this stronger together. Thank you.
Next question from, I think we'll take just 2 or 3 more questions before we close. Edita from Paris Saclay asks, can you briefly explain why there is a depreciating rupiah and the Indonesian rupiah continue its weakening? Did the government not prepare a good scenario to deal with this pandemic? So anyone want to say that?
You want to?
Go ahead, Enrico. Well,
yeah, you go ahead first. I will add on.
Well, as I said, because 40% of our bondholders are foreigners, yeah, and in addition to that, we issue about 25% bonds. So majority of our bondholders are basically a global bondholders. So when there is a shock in the U.S., they go to the flight to quality into USD bills. They're gonna dump our bond. They convert the rupiah into US dollar, and that's the reason why the rupiah depreciated, quite severely in the last couple of weeks. Similar situation also in the stock market. So one of the reasons the capital outflow happening in Asia was because of the flight to quality to the USD bills.
If I may quickly answer that question, is actually because we run a current account deficit, which means that we still need to see rupiah in depreciation. But I think the more important question is why rupiah is so important such that everybody is questioning the impact of this flexibility in absorbing shock. Is because this economy has a relatively high import content. That's why the omnibus law and so on and so forth is basically to do a structural transformation to make sure that we use more of a local content in order to lessen the import part, and at the same time rely more on FDI to finance the current account deficit. That's why we need a reformation such that basically the rupiah, whether it goes up or down, it is just a shock absorber. The fact of the matter is we come into realization a bit late, because once the commodity revenue collapse, there is not enough financing of the dollar. That's why we depend a lot on the foreign flows. And basically, exactly because of that, the rupiah becomes so sensitive such that when it's weakening, we are fearful that it might collapse. Actually, if we are an export-based economy, like we do a value-added manufacturing or a value-added in our agriculture, basically this is a good adjustment, the so-called J-curve effect, when whatever will work better for the economy. But until we change the structure of that, then basically there are 2 things that will keep the Indonesian economy. That will, every time there is a shock. Number 1, of course, is the rupiah depreciation. Number 2 is, of course, the commodity bust. We have lived with the first fact, but not the second. So until we correct that structural imbalance, I think we have to live that. Basically, if rupiah depreciate gradually, this is acceptable. What is unacceptable is right now there is an overshooting of at least 3 to 4 times of the acceptable depreciation rate. So that's why I think the government is doing, especially the BI, OJK and whatnot, to ensure that basically our yields are still attractive because we are still reliant on foreign financing. But once the dust really settled, yeah, I think our yield differential will be very attractive such that it will come back to be in a more sustainable level very quickly. Thank you.
Yeah, last 2 questions. One is from Timothy Tatendang from Udayana University. The question is, I would like to ask Dr. Abdul if there is any contingency economic policies provided by IMF, World Bank, or ADB during this pandemic. And the second question is from a diaspora Indonesia in Kuwait. He's asking, what is the effect of the COVID-19 to the oil and gas sector in Indonesia, and whether the lower oil price will help Indonesia economy growth? So those 2 questions. Dr. Abdul?
Okay, let me take that first question. So I'm not sure what contingency economic policies mean, right? Policies belong to governments, not to these international organizations. What these international organizations are able to provide, as Pak Khatib had mentioned, is financing, knowledge and financing. So a couple of things that Pak Said had already mentioned, some of our facilities, but many of our member countries are, for example, tapping, they're called emergency assistance loans. Basically, when you're hit by a natural disaster and a pandemic counts as a disaster, you can tap these so-called emergency assistance loans to support. So, for example, in this case, if you need increased health expenditures. So that's one. The other is another type of loan that ADB has, and others have this as well. It's called the countercyclical support facility. That basically, so long as you are your debt is sustainable, basically it helps countries respond when you are hit by an exogenous shock that results in a downturn. And so we are seeing many of our member countries applying for this precisely because in some countries have more fiscal space, others have less. But for a big and temporary shock like this, what you want to be able to do is to be able to respond, to be able to absorb that shock. And so there are these facilities. We have them available. So one of the nice things also now is that every week there's coordination between between the IFIs, so regional development banks, the World Bank, IMF, and others, so that we are both cognizant of sort of what everybody else is doing, and we're sort of cooperating to make sure that all bases are covered. Let me stop there. Thanks.
Okay.
If I can just add a little bit, if I can just add a little bit to what my colleague Abdul has said. Indonesia has tapped into some of these financing support that ADB can provide. ADB has also tried to rally, try to coordinate with other financial, other development partners to be able to bring a financing package to the government that will help them provide some relief to the budget deficit. In addition to that, we realize that particularly in this environment where you have limited supplies of medical goods that can be used to provide direct response to COVID-19. We are also in collaboration with UN agencies that may have a bit more latitude in terms of tapping into the international markets for, let's say, various supplies, medical supplies, whether that's PPEs or whether ventilators and so forth. So that's so rest assured that in Indonesia, international support is available. International partners are collaborating, whether they're MDBs as well as UN agencies. Now, one more point to add is that in terms of deferred drawdown option, so we call it precautionary financing option. That's part of the financing modality that ADB can provide. But typically, those sort of assistance is given more, when countries are not in dire need of budget support, but more in terms of signaling to the market that there is a trust from international partners. And Indonesia did tap into this in 2009 and 2012. I think the situation here is slightly different, and that's why probably deferred drawdown option is currently not, as I understand, one of the options pursued.
Okay. The last question on the energy. Anyone want to answer that? That's a lower oil price. Yeah, please.
Yeah, I just want to. This will not be good for Indonesia, unfortunately. Why is that? Because it's gonna hit the government revenue, royalty, the government revenue, and also declining the, the coal price, the CPU price. But on the spending side, the subsidy is no longer in our budget. It is burden the Pertamina now. So the net impact for our budget is negative, in the sense that this is not really a good story for us.
Okay. Anyone else want to chip in before we end the session? Good, thank you. And on behalf of FPCI and all our viewers, I think we hit quite a lot of, yes, we hit it out of the ballpark, by the way. We want to thank you for your insight, for your analysis, and your assessment. I think we all learned a lot more than we had assumed before. And to be honest, I'm a little bit more optimistic about the scenario in the coming month and year. So I want to thank all our speakers, Dr. Khatib Basri, Pak Abdul, Abiad, Enrico Tanuwijaya, and also Said Zaidan Shah from ADB. Thank you very much for spending your time here with us, and I hope you will come back and talk to us again. Thank you very much.
Thank you.
Have a good day, everybody.
Thank you, Pak Dino.